Start the call.
Yep. Hello and welcome everyone. Welcome to Lupin Investor Communication FY 2021. Please note all participants line will be in the listen only mode and there will be an opportunity for you to ask questions after the opening remarks. Should you need assistance during the conference call, please raise your hand from participants tab on your screen. Please note that this conference is being recorded. I now hand the conference over to Lupin Management. Thank you and over to you, sir.
Yeah. Hello, good evening. My name is Kamal Sharma. I have with me my colleagues Vinita Gupta, CEO, Nilesh Gupta, the Managing Director, Ramesh Swaminathan, CFO of the company, Arvind Botra, Head of Investor Relations, and Vishal Rathi. It's my pleasure to welcome you all on all our behalfs. You already have the financial results in your hand, and you would have seen that we've had a good quarter. What you get to see is that while we might have had a lower sales by 4% in a sequential quarter, our sales year on year are flat for the quarter. Reasons are pretty obvious. The fourth quarter for India, which is almost 34% of our business, is generally soft, and it was a very poor flu season in the US. So there were obviously challenges for some of the major products that we have in that group. But what's interesting and what you would have seen already that on a corresponding quarter basis, we have improved our EBITDA substantially by almost 500 basis points. On an annual basis, we are more or less flat on revenue with about a drop of about 1% given the entire year, ridden with COVID challenges across geographies. I think that has been, the team has done reasonably well to at least maintain the revenues. And what is to me very heartening is that the EBITDA has definitely improved by about 220 basis points, which we had promised you in the past. And we do hope to keep working on this even as we go forward. With that little commentary, I would hand you over to Ramesh to share with you the financial details, and then we'll open the floor for question and answers. Thank you very much, and over to you, Ramesh.
Thank you very much, Dr. Sharma. Dear friends, welcome to our results webinar. I trust all of you are keeping well and your family members also, they're all doing well. It's a terrible time out there, so it's important that we all stay safe. Let me walk you through the key aspects of our Q4 performance. Q4 has been a challenging quarter for us, given the surge in COVID cases with the second and third wave across many geographies. And this is true for a lot of other pharma companies also. In this tough environment, the company's sales have actually come down by 4% sequentially and 0.8% year on year. The US business saw a 4% growth sequentially, the continued ramp up of albuterol. This was despite the continued impact of the weak flu season. Across various parts of the globe, a weak flu season impacted our sales growth both sequentially as well as over the previous year. However, in spite of the headwinds on the growth of the company, we continued on the path of improved profitability. The operating EBITDA, excluding the one-time settlement income in Q3, improved sequentially for the fifth quarter in a row due to the improvement in business mix and sustained measures on the cost front. We endeavor to drive our sales and profitability by driving the profitability mix, bringing more niche products to our portfolio, and continued improvement on our cost control and optimization initiatives. Sales for Q4, the results are with you, were rupees 3,759 crores compared to 3,917 crores in Q3, which is a 4% growth. However, there was a degrowth in America. Vis-a-vis the previous year, there's a degrowth over Q4. Coming to geography-wise sales, US sales grew by 3.6% sequentially, USD $195 million in Q4 as compared to $188 million in Q3, and low by 8% as compared to Q4 FY20, which is 212. But you might also recall that COVID was round the corner, and there was a surge in demand in anticipation of lockdown conditions in America, and also it was a normal flu season. The sequential growth was driven up by ramp-up in albuterol and other new products like fosconazole that more than offset the flu season decline quarter on quarter. Demand for seasonal products continued to be weak on back of the weakest flu season in the last decade, leading to a $36 million fall in sales of oseltamivir, azithromycin, and cephalosporins as compared to Q4 FY20. The India business, Indian branded formulation saw a growth of 3.3% year on year as demand picked up. As per IQVIA, Lupin's growth in Q4 was 5.9%, vis-a-vis 8.5% for the IPM. Acute product sales have grown in Q4 versus degrowth we had seen in Q1 and Q2, and is higher than Q3. For the full year, IRF exhibited a growth of 0.7% vis-a-vis the previous year. As per IQVIA, IPM growth is 4.3% compared to Lupin growth of 3.9%. However, if you look at chronic therapy, Lupin has outperformed the IPM. It's 10.2% growth for Lupin as compared to IPM growth of 8.4%. API sales showed a 25.6% degrowth quarter on quarter due to low volumes on some of our key antibiotic APIs on account of weaker flu season in most parts of the globe. Insofar as EMEA and growth markets are concerned, EMEA grew by 14.6% quarter on quarter due to strong demand in South Africa, Namuscla, and scale-up of etanercept. Sales for growth markets is low by 8.5% sequentially due to the second wave of COVID hitting us in several countries. On the gross margins front, Q4 FY21 gross margins is 65% as compared to Q3 FY21 of 64.9%. This is driven by improvement in business mix in US, driven by albuterol. However, on account of slowdown in seasonal products, the flu season, we have had higher write-offs in this quarter. Thus, the net improvement was just 10 basis points. Over the previous year, the margin improved by 210 basis points, which is primarily on account of better mix in US and higher API margin. This is partly offset by higher freight rates and high growth in low margin business of Brazil and Australia. We've done a stellar job when it comes to, in fact, the employee benefit expense. In Q4 FY21, it was 640 crores as compared to 706 in the previous quarter. And if you recall, it was 764 crores in Q4 last year. Lower expenses in Q4 is largely due to one-time savings coming in from truing up of annualized schemes and change in policy. We, however, expect employee costs to be sub 18% range in spite of the increments which will kick in Q1. We've brought it down from less than from 20% levels in Q1 FY21. It was plus 20%, if you recall, 22%, which is a very, very good achievement. Manufacturing and other expenses, Q4 is at 1,125 crores as compared to 1,156 crores in Q3 and 1,151 crores in Q4 FY20. The decrease of 31 crores was driven by low selling and promotional spends, offset by higher royalties on partner products. On the EBITDA front, as Dr. Sharma was saying, we have reported a fifth consecutive quarter of operating EBITDA margins improvement in spite of degrowth in sales. Operating EBITDA is 18.8%, excluding forex and other income for this quarter, just 20 basis points higher than normalized EBITDA of Q3. As you recall, Q3, whilst the top line EBITDA margins are higher, it is because of one-time settlement income. And you would also appreciate that, there has been continuous increase over the last 5 quarters, which has been, a result of several initiatives that we have taken in terms of, various initiatives on the cost front, including procurement, routes to synthesis, renegotiating contracts, rationalization of, in fact, our sales force in America and other parts, and so on. We continue to strive to work on this, and you'll see better, certain improvements coming across in the future as well. We're particularly proud about our achievement on the effective tax rate on this front. In the course of the year, we have been working on various initiatives to optimize the overall ETR, and with the fruit of this reflecting in the full ETR numbers, it's come down from 40% last year to 26.7% for the full year. In this particular quarter, it is particularly low because we have kind of over-provided in the previous quarters, and we kind of wrote it back. And it's also because the fact that several of our subsidiaries, turned profitable, especially America, Brazil, as you might have recalled, it broke even last quarter. We expect the ETR to remain at similar levels in FY22, and we'll be continuously working to further optimize on this. With this short introduction, I would open the floor for discussions.
Thank you. We will now begin question and answer session. Anyone who wishes to ask question may raise your hand from participants tab on your screen. Participants are requested to use headphone or earphone while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We request you to please introduce yourself and your company name before asking the question. Thank you. First question is from Damayanti Kerai. Please unmute yourself.
Damayanti, you're still on mute.
Yeah. Sorry about that. Am I audible now?
Yes.
Okay. Thanks a lot for the opportunity. So my first question is on albuterol traction in the US. So first, how much market share we have reached? Because Symphony data is, I think, not reflecting the pickup yet. So that's my first question. And have you seen any change in market dynamics after recent entry of Sandoz in the market? So can you please comment on albuterol market?
Yes, Damayanti. Market share so far, as IQVIA reports it, is at 8% level, just over 8%, and it is kind of lagging. Obviously, our supplies are ramping up, and the market share will continue to ramp up over the next few quarters. We haven't really seen any material change since the switch over to Sandoz, of the Ventolin AG. So really no shift in the market dynamics. It continues to be a very very strong opportunity for us, and we continue to ramp up our supplies as well as market.
Okay, Vinita ma'am, so pricing is largely stable in the market, right, for albuterol?
Yeah, so far pricing has been stable.
Okay, good to hear that. And my second question is on some update on the inhalers franchise. So can you update us on the status of Foster launch in Europe? Earlier you indicated to launch it by end of FY21. And maybe you can comment on Brobana opportunity. Should we consider this as CY21 launch?
Yeah, so both Foster, we've made significant progress with the UK agency, with CHM, and are expecting approval soon. So that should be a launch soon in the next few months. And Brobana will be another material product for us for calendar year 21, fiscal year 22. So really the inhalation portfolio led by albuterol ramp up, then Foster launch, Brobana, Performist will be significant driver for fiscal year 22.
Okay, ma'am. I have more questions. I'll get back in the queue.
Okay.
Thank you. Next question is from Nithya Balasubramaniam. Nithya, yeah.
Hi, this is Nithya from Bernstein Research. A related question again on your respiratory generics portfolio. If you can update us on what you might have heard from the FDA on your Spiriva filing, and again, some color on when you expect to launch the product and how the litigation is progressing as well.
So we've had good communication with the agency. There's been a lot of back and forth over the last couple of months. We are in the process of responding to the agency's questions and feel pretty good about getting the approval for next year. The litigation is later this fiscal year. Again, we have said in the past, we feel pretty good about our position and our ability to launch the product next fiscal year.
Okay, so is there clarity on, do you have a minor CRL? Is this going to be, once you respond, is this going to be a 6-month review process, 8-month review process? Can you throw some color on that?
Yeah, we have got priority review on the product, and we intend to respond in the next quarter, and would hope that within by middle of next year, we even with one additional round of questioning, we should get approved.
Got it. The second question was on tax rates. Ramesh, you were alluding to this, but just to get some clarity on what is your guidance on the tax rate that you expect next year? Is this likely to be in line with fourth quarter?
Well, fourth quarter was really an aberration. So you could take the full year as perhaps the guidance for the future as well. But 27-28% is where I would place it.
Got it. I have a few more questions, but I'll get back in line. Thank you.
Thank you. Next question is from Kunal Dhamesha.
Yeah. Hi, this is Kunal Dhamesha from MK Global. So 2 questions. First, on the employee expenses, you said there was some one-off, but I missed that comment. What was the quantum of that one-off? And if you can share that, that would be great.
So I said the one-off is essentially because of the fact that we had provided for sales incentives and the like, which didn't materialize because of the fact that the actual sales was lower. So we kind of wrote it back. So you could expect, in fact, an increase in the quarters to come. But overall, we're still keeping the overall costs on a leash, so to speak. So it's going to be in the 18% range.
Sure. And the second question is on the status of various plants which are currently under regulatory issues. Any update on that front? Are we seeing any progress in terms of the desktop audits in any of our plants?
Kunal, as you know, FDA has come up with a remote interactive evaluation guidance. In the best of our understanding, that has not really kicked in meaningfully for any plant in India yet. So the status remains the same. We have told FDA that we're ready for our Goa, Pithampur Unit 2 and Tarapur plants. And we're hoping that, this is going to be the way to engage with FDA because, right now it's extremely unpredictable of when, FDA would be able to travel to India. And we believe that this will be the way. I think it's a big positive that they've come up with this guidance, and it really is applicable for everything. It is for surveillance, it's for OAIs where CAPAs are complete, for PAIs as well. And we think that most other agencies have adopted this approach already, and we're hoping that the FDA will start reflecting it in their actions soon as well. We don't have a specific update at this point of time, but I think the fact that the FDA has come up with that guidance and approach is a big positive.
Sure. Thank you. Thank you, Nilesh.
Thank you. Next question is from Neha Manpuria.
Yeah, thank you for taking my questions. This is Neha from JP Morgan. Vinita, on the US business, while Albuterol, like you indicated, could see a ramp up, just wanting to understand, what led to supplies being, shorter than expected, because in February indicated to the product gaining traction over the next few months, which hasn't really happened. What really happened, and what gives us the confidence that this would improve going forward?
So, there were supply issues, especially coming out of the valve supply in the UK. Just given the impact of the second wave. But we did we did have a ramp up of supply, Neha, and that continues. We have a strong commitment now on supplies, and we did ramp up albuterol quarter over quarter. It doesn't show up in share as of yet. Because share will lag, the market supplies, but it will show up as we get additional, new data from IQVIA. So now that we have commitment on supply of valves, of course, everything is COVID permitting. Our team is very hard with the valve suppliers to ensure that we get what we need. We feel pretty good about that.
And we are still committed to the 20%, market share, fair share that we'd indicated in the past.
That's right. It's not going to be overnight, of course. We're building it up in a very prudent manner to be able to maximize. But we expect by the end of fiscal year 22.
And my second question, just extending it, on the US business, giving one of our key products could likely see, erosion in the first quarter. We have obviously albuterol, but if you could give me a little bit of sense on, how you see your US business shaping up for FY22 in terms of, what you expect in new product launches, what would be the key products, that could drive the growth in this business?
Sure. So the largest part of the growth is the inhalation portfolio for fiscal year 22, starting with albuterol and then, Brovana, Performist, all contributing towards growth in fiscal year 22. The near term, early in the fiscal year, we have the challenge with, additional competition on famotidine, which has been a material product, has been built into a material product for the organization, but are managing, within that competitive landscape to hold on to significant share. And we built a lot of goodwill with the customers over time as we ramped up the product, with the ranitidine decline. It was we feel pretty good about holding on to significant share and maximizing value as much as we can. So combination of, so there are obviously is going to be erosion on the famotidine front, but we expect to more than make that up and support a very strong double-digit growth with what we have planned around albuterol, the other inhalation products, Brovana, Performist, and also growth in our inline products. This past year we had challenges from a supply perspective, COVID-related. On our inline products, we expect to really get back to normalized levels in fiscal year 22, which will also help the double-digit growth.
Understood. Thank you so much.
Thank you.
Thank you. Next question is from Rohit Jain.
Rohit, you're still on mute.
Yeah, hi, can you hear me?
Yes.
Yes.
Yeah, hi. Hi, my name is Rohit. I'm calling from Tara Capital Partners. I just had one high-level question. I just wanted to understand the promoters' commitment to the business. What I want to ask is, are we committed over the medium to longer term, or are we a willing seller at the right price? Thank you.
Oh, wow.
And the context of this question is that a lot of things keep coming up in the market, so just wanted to get some clarity over there.
Well, let us put that to rest. We are extremely committed to the business. To us, this is not just a business, it's our family's legacy. And we take a lot of pride in what we have built. We have, I believe that we've had a couple of challenging years, which maybe have led to this kind of rumor. But we are in a very strong position today. We really turned around our business, have very significant growth drivers when we look at the next 5 years, and a complex generic strategy, a specialty strategy, our biosimilar strategy, India market growth prospects, US market growth prospects, other regions. We are very excited about the business, and we'll continue this legacy.
Okay, thanks. That's a very clear answer. Really appreciate it. Thanks.
Thank you. Next question is from Mr. Prakash Agarwal.
Go ahead, Prakash. You're on mute now.
Hello, am I audible?
Yes.
Yeah.
Yeah, good evening, and thanks for the opportunity. Just some clarification here. I mean, obviously, double-digit growth with an exit rate of $195 million is done deal, right? So you were 800 last year, and fiscal 21 you ended around $720 million for US. So I mean, 10% is 800, and you're already doing 195. So I mean, I totally understand last year, COVID year, and there was a mention of, safe business, azithromycin, and all our, antibiotic business had a hit due to COVID also. Looking forward with so much in the pipe, which we just talked about, is there a broad level, number we can work with for, 22 and 23 in the US?
Prakash, we don't like to guide, and we're still dealing with the impact of the pandemic, right? I mean, in India in particular, from a supply perspective, as much as our team has, worked very hard to ensure that we continue, challenges do crop up. But we remain very confident of growing it. Our goal really in the next couple of years is to get to that $1 billion plus, sooner rather than later. But we know that we need to really get through a couple of quarters and just execute and deliver, to make that happen. We certainly think that, in the next 2 years, we are set to cross that $1 billion mark.
Okay, and tying this with the margins, and obviously there was a comment that US is just turned EBITDA positive. So with this adding about $200 million, over $200 million over next 2-3 years. So I mean, there is a clear, any color you want to give in terms of margin expansion, or reiterate what we have said in the past?
So actually, what Ramesh was mentioning about US EBITDA positive was more the US entity from a tax perspective, which has led to that optimization on the tax front from 40% the year before to 26-27% this year. The US has always been EBITDA positive, and it is has been very strong EBITDA contributor in fiscal year 21. Will continue to be a bigger contributor in fiscal year 22 and beyond.
Prakash, it was, I mentioned Brazil as EBITDA. America has always been profitable. We took an impairment in the last couple of years, and that's where we actually had a lot of NOL. So you're not paying taxes in America. That's what we meant.
Yeah, fair enough. But any reiteration on the margin expansion, which we have said in the past for the next 1 to 2 years?
Yeah, we definitely expect margins to continue to expand. I mean, this year, past year, we've had a significant quarter-over-quarter improvement over the last 5 quarters from the 15% level to the 18.8% level. We expect to be 19% plus in the next fiscal year, and certainly in fiscal year 23, we're working hard to get to that 21 to 22% level.
Yeah, that is very helpful. And last question on the India business. I mean, there's a comment on the AICD, which is the industry body. It talks about monthly data points that, there's a use of medicine to increase given the, the huge surge of direct and indirect COVID-related products and the after effects, be it, these steroids and, leading to more diabetes, cardio. Any sense there? Do you expect the this overall use of drugs and the volume to increase what you've seen in the last year?
Yeah. So I think in the near term, this is reflected obviously much more in anti-infectives and everything that goes into COVID care, right? And it's a pretty wide spectrum, right, from products like budesonide to products like baricitinib and Fabiflu famously, and the like. So I think that's what we're seeing right now. But I think what is getting highlighted very clearly is that India is terribly under-indexed on the healthcare front, and there has to be investment. There certainly is heightened sensitivity around that. I think it's a real crisis which is going on in India right now, and obviously we're seeing a very grim situation. But I think I hard to predict at this point of time, but everything seems to indicate that obviously there will be heightened focus on healthcare going forward, and that will lead to further market expansion.
Thank you. All the best.
Thank you. Next question is from Surya Patra.
Yeah, thanks for this opportunity, sir. First question, if you can help me understand, what is the kind of performance that you are currently seeing for levothyroxine and the relaunched metformin in the US currently?
Yeah, so on levothyroxine, actually, quarter by quarter, we have grown share. At the start of the fiscal year, we were at the 12%, market share level, within the generic market. Today, we are close to 19%, 18.7% level. So have seen ramp up quarter after quarter in levothyroxine. Our team worked hard to deliver that, and will continue on that path, to build share on a profitable basis. On metformin, so we had to unfortunately get out of both Glumetza as well as Fortamet due to the NDMA concern, and we're very pleased that within a quarter, our team got the product back to market. Was at lightning speed that our team worked to make that happen. But, as we got back into the market, we had to really earn our share again. I'm very pleased to say that we already at 50% plus share in Glumetza again. Of course, like I said, we had to earn our way, so the pricing is at a different level, but it continues to be an important product in our portfolio. Fortamet, we are yet to launch. We are in the process of planning the launch of Fortamet, but we expect to launch that back again.
Can you just give some sense about the size of this product, ma'am? Because this is a renewed market now.
Yeah, so we don't give product-wise sales, so I wouldn't be able to give that.
Industry-wise market that one can consider or target from that angle, if you can just provide.
I guess I will just say that, Glumetza, at one point in time was a very important product in our portfolio.
Right.
Now it's a smaller product, right?
Wow.
Even in the last fiscal year 20, it was a smaller product, and it's even smaller.
My second question is on R&D, ma'am. R&D and obviously having implication on margins. So if I see the kind of R&D performance of Lupin, for last 5-year period, let's say, what is the kind of cumulative R&D, both revenue as well as capital R&D spend of the company, and comparatively see with the kind of incremental revenue growth or business growth it has provided, then the trend may not be great, possibly because the kind of front-ending of all this R&D spends on the complex projects without any commensurating sales from those. But I think the kind of visibility that is there, at least 5 innovation products over current year, next 2 year, I would say rather, which can possibly bring in a significant kind of U-turn or J-curve kind of a recovery on the business front, and similar kind of implication on the margins driven by sales progress. But simultaneously, I think which is difficult for us to estimate is that the moderation in the R&D spend, what it can see or what you can see. So that can really surprise on the margin front. So if you can deal with these two aspects, that okay, what expansion that the specialty projects that you will be seeing from the possible 4 key product opportunity over next 2 years, and what kind of a further boost on the margin side that you can achieve because of the moderation in the R&D spending.
Yeah, so you have multiple questions there, but I'd say that your point was correct, that it was front-ended, the investment was front-loaded, on the complex generics, on all our platforms, whether it is inhalation, complex injectables, biosimilars. It took time to establish them. It took time to establish capabilities. It took time to really get pipeline together, but we're starting to see the results of it. So as we look at now the inhalation portfolio paying off, we will see in the next couple of years the ramp up of the inhalation portfolio-based business. Then the injectables will start contributing. I mean, we have now a very solid portfolio on the injectables front with depot injectables, peptides, iron products, liposomal products through a partnership. So that will start contributing in the next 2 to 3 years. And biosimilars, started contributing ex-US with Etanercept, but in the next couple of years, we would start seeing contribution of products like pegfilgrastim and then ranibizumab and beyond. So definitely, when we look at, we obviously are looking at our return, and as we look at return over the next 5 years, the complex generics are our biggest growth drivers. When we look at our 5-year plan. So our margins, our revenues, of course, but also margins going forward. And overall, your question on R&D investment, as Ramesh said at the beginning of the call, that we have managed to keep R&D investment under control. We were over 10% 2 years ago. We are at the 9% level in this past year. And we will continue to, it will continue to decline as a percentage of sales, while our R&D investment continues to increase year over year, just given, our revenue potential is also pretty strong now going forward. I hope that answers you.
Yes, ma'am, to some extent, but is it fair to believe that the trajectory, the margin expansion trajectory could be really strong over 3 year or kind of, but it would be to a greater extent means back-ended kind of a trend, or in the interim period it could be a staggered one. Is it the kind of indication that we are talking about?
No, we expect to get to the 22% in a range. We think that will be the very base, and whenever there is introduction of a newer product, it could spike up to to 26, 27, but come back to the same level. That's going to be our endeavor. And as Vinita and others were also saying, is essentially going to be on the back of 3 things. Essentially, the kind of products that we would be bringing to the market. And Vinita did give us a flavor of the fact that we are looking at a host of complex stuff, the complex injectables, the inhalations, the biosimilars, and of course, specialty itself at some point. So, and that apart from that, we have been continuously working on cost improvement in terms of procurement policies, in terms of routes to synthesis, renegotiating on contracts, looking at rationalization of our workforce on the sales front, on the R&D front, and manufacturing front also. So all of this has been paying results. Obviously, there's more to come. It's a continuous exercise. With these, we do believe that we've been marching in the right direction in the last 4 to 5 quarters. There's more to be done. Even this year, we expect to between 19 to 20% would be potentially the target for FY22, and improvement on that in the next couple of years.
Okay. Thank you, Mr. Surya. Next question is from Mr. Sarvanan Vishwanathan.
Yeah. Thanks for taking my question. Are you able to hear me, please?
Yes, go ahead, please.
Yeah. So Ethernacept, what is the update? How is the launch in Germany and Belgium played out, and France markets and other markets, your target markets, have the launches taking place?
So it is launched in the last 6 months, obviously, in Germany, Austria, Eastern European markets. France is yet to happen, but it's in the works. Germany was the highest priority market as we were building supplies for the partnership with Mylan, and we worked to maximize that. So we have seen a ramp up in revenues quarter after quarter, between Q3 and Q4 on Ethernacept, and we'll continue to expect that going forward as they launch in other markets, both in Europe as well as ex-Europe, Australia, and other countries.
Okay. And pegfilgrastim is the go-to-market timelines. Is it happening this year?
Well, the go-to-market plans, yes, but we just filed the product, are still waiting for acceptance from the agency, and that facility has not been inspected by the FDA. So we're going to have to see how, what the timeline looks like from a FDA inspection standpoint. Will they accept a remote inspection, or will want to, really wait for on-site inspection? Really the inspection will be the determining factor on the launch date, but we're getting prepared to be in a position to launch within 15 to 18 months.
As regards the India business, would we expect to grow in line with the market for this year?
Yes, so I think we should be back to double-digit growth. Obviously, the current quarter we're seeing growth, but more connected with products for treatment of COVID. Otherwise the market had started to bounce back. Doctors had come back. Now doctors have scaled back a little bit from clinics. Patient footfalls have come down a little bit as well, but we expect double-digit growth in FY22 out of India.
Thank you. Last question is on the debt levels. So can we expect it to go further down, or do you have any inorganic plans?
Obviously, so we are near debt-free company. We have actually repaid our loans, our Gavis loans, during the course of this quarter itself. But you would also appreciate it's not desirable to be a debt-free company, because it's possible to trade on equity by having some debt on the balance sheet. And we have plans, so it's obviously plans for looking at acquisitions also. So we would raise when the occasion really demands it, and that I think would be good for the shareholders also.
Okay, thanks a lot.
Thank you. Next question is from Mr. Samir.
Hi, greetings everyone, and thanks for taking me in. Quick question on Revlimid. Vinita, how are you thinking of monetizing this asset? Can this be a 2022 calendar event like 4 or 5 other companies?
Yes, Samir, we are looking to see how we can bring it in sooner rather than later.
Okay, excellent. And second question is on Spiriva. Vinita, just in terms of court process, where exactly are we in terms of discovery, Markman's hearing, and what's your best guess? When could there be a full-fledged trial that can start?
I believe, right now it's running slow, but we'll pick up pace in September, Samir. So, September onwards, based on the court proceedings, and we'll get a read on the timeline, litigation timeline.
With that, going by, the other examples, so many that happens, the pattern challenge, it looks like where your case is right now, it is almost impossible that you will get a district court ruling by middle of 2022.
Yeah, so it will very much depend on, in the last COVID year, we have seen that courts have been very efficient on, on remote proceedings. So we'll see what happens, but it has been slow, the litigation timetable. So yeah, it could take a little bit longer.
Okay,
We still,
great.
we still expect the product to be launched in fiscal year 23.
Okay, that's very nice. And one final question is on, and I don't know how you'll respond, but on US FDA, I'm sure the agency must be having a massive amount of backlog of both routine inspections, site inspection, product specific inspection, and then all the OAI, warning letter, etc. So as and when things open up, what do you think would FDA prioritize, whether it's virtual or physical? What would it mean for companies like yours, which has multiple manufacturing sites? Can there be a bunching of big issues? Will it be a bad news or a good news? Just your thoughts on this.
Maybe I can start, and Vinita, you could add. So first of all, I do think that FDA is I think FDA is very cognizant of the backlog that is getting created of surveillance, and in addition to the surveillance inspections, just all the other inspections which are for cause. From our perspective, we had a great start last year up to March, where we had 6 consecutive positive outcomes out of FDA inspections. They cited some of the observations which have plagued us for a while, like investigations as well, and yet we received the IRs and satisfactory closures. We worked a lot, especially on some of the India sites like Pithampur Unit 2, lesser so in Goa and Tarapur, because there wasn't a deeper fix that we wanted to put in place. And we would welcome the flow of inspections to restart. As you know, I think we're over-indexed on the number of sites which are at some degree of non-satisfactory compliance, and it is a clear organization goal that we have to overcome this.
We do think, just to add to that, I think the priority would be first to market products, first to files, high priority products, especially products that have, or areas that have surged through COVID, will continue to be a priority, we believe.
Okay, thanks. And one final, with your permission, if I may.
Mr. Sameer, sorry. We'd request you to come in the queue again, because we'll let others also get a chance to ask the question.
Thank you.
Yeah, thank you. Next question is from Mr. Kunal Randiria.
Good evening. I hope I'm audible.
You are.
Yes.
Yeah, thank you. So my first question is on the US business. So I believe you have launched close to 15 products in the US this year. But if I go through the press releases, I see that the number of products in the market currently has gone down from 175 to 168 or so. Does this mean, you have discontinued around 20-22 products? Is my understanding correct over here? And if so, is the portfolio rationalization exercise complete, or you're still looking to rationalize some of the non-profitable SKUs this year too?
Yeah, so in the last couple of years, as we optimized our business, we definitely look at portfolio optimization where it didn't make sense. We, got out of the product. But overall, it's behind us, the portfolio rationalization. We think that, pricing, the kind of challenges that we faced, until a year before last, we think behind us. And that's not to say that price will not continue to be a challenge. We, in the generic business, that continues to be a challenge, but we hope that the single-digit price erosion that we contend with, we can offset it with volume growth, cost reduction, continuous cost reduction efforts. So we do think that the portfolio rationalization process is behind us.
Sure. And it would be fair to understand that this is what led to, to your gross margin improvement in the current year.
Well, the gross margin improvement was definitely product mix. Good part of it led by albuterol as well, high margin products that we grew.
Sure. Okay. So my second question is on the India business. So I was just wondering, while Nilesh did mention you are going to see double-digit growth, any particular area or any particular therapy, which is doing particularly well for you, and any therapy where you're sort of lacking, and growing behind the market? I think especially on the acute side. So what's your strategy to revive these? Just a bit of a more, understanding on how you're looking at the India business.
Sure. So as you know, the big three areas for us in India are cardiac, respiratory, and diabetes. In particular, diabetes is the fastest growing amongst the segments, about 20% at this point of time on a significant base. Again, as I've said in the past, we're not number one in any of these, right? So I think we're number, three in pretty much all three of them. And there is significant room for growth. So all these three will continue to be the big areas for us to grow. And obviously we are weighted more towards the chronic side than the acute. Right now we're seeing a resurgence on the acute, which is gonna help pick up sales as well. But that's not the bigger strategic story. I think the bigger strategic story remains around these three areas, and then carefully adding others. We are very highly under-indexed in areas like dermatology, for example, and even weaker in areas like women's health, or even in vitamins, minerals, and supplements. So we're in everything, but I think the idea is to really build bigger brands and build deeper positions in select areas. But these couple of areas like dermatology, BMS are the areas where we would want to build, but the main focus will remain on these three.
Got it. Thank you and all this.
Thank you. Next question is from Mr. Ranveer Singh.
Yeah, hello. Am I audible?
Yes, yes.
Yes, sir. So my question pertains to API business. So after witnessing a 3 quarters of very good, number, we see a blip in Q4. So what would be the run rate we should take on that API side?
Sure. So I think the API business, going down in Q4 is really a sign of, the flu, the anti-infective business, how it's been impacted globally. Big products like cephalexin and the like are significantly down globally. We talked about the US pretty much having a non-existent flu season this past year. The same has been the story in other markets as well. That has been the main reason for driving this. We do believe that it'll start picking up. We already see signs of it picking up in important markets like China for us. Likely Q2 onwards, we would see it picking up again. There's a significant bunch of new products that we have planned on the API business as well. We've been lagging on building enough new big API products, and that is a focus area at this point of time.
Okay, so just wanted to understand from industry perspective also that last 3 quarters for industry itself, that API business has been very strong. So wanted to understand whether the competition or pricing scenario is getting changed versus last few quarters. That perspective I wanted to understand.
Not really. So I think we're all facing input cost increases from markets like China, for example. And I think that's pretty much across the API industry. But no, I don't think there's a fundamental change in the competitive dynamics which is driving this. This is primarily demand related.
Okay. And another related to that API business, normally we get higher than the company's margin, average margin, or it is lower than the average margin on EBITDA front?
So typically, at the gross margin level, obviously finished product business would be of higher value. The API business is almost at a similar EBITDA margin at the company.
Okay. Okay. That's it from my side. Thank you.
Thank you. Next question is from Nitin Agarwal.
Nitin,
Please unmute yourself, Mr. Nitin. Yeah, you can go ahead.
Nitin, we can't hear you.
I think we are facing a problem. We'll go to the next person. The next question is from Cinderella.
Yeah, hi, team. Thanks for taking my question. I want to understand over the past 2 years, the margin contraction that we have seen. If we can highlight what was our learning from, and which regionally, if we could highlight which were the regions which were actually creating this kind of impact, and what is the strategy going ahead to commit to the 22% level that we just set out the goal.
So,
Actually, go ahead. Please go ahead.
No, so essentially, as you would recognize, it's really a function of of sales growth and cost. So if costs go ahead, grow at a faster pace than sales, and you potentially have an EBITDA margin problem. So the last couple of years, our sales were kind of stagnant, whilst the expenses grew. And particularly so for example, you saw manpower costs going up significantly, ramping up quite significantly. In the first quarter, it was close to about 22%. So as long as we are able to bring in newer products and keep an eye on cost, we should be okay. And that's exactly what we've been trying to do over the last several quarters. So we have been working on several projects when it comes to on all the cost lines, so to speak, starting from gross margins, comprising of procurement costs as well as cost of conversion. Those are there's a lot of focus on that. We work with external consultants to get that focus. And of course, when it comes to a host of lines beyond that, when it comes to, for example, the indirect costs, SG&A expenses, contracts that we renegotiate with a host of vendors, we brought in productivity gains on R&D, as well as on the sales force, we rationalize sales force in various parts. All of this kind of helped to kind of rein in the cost. Even during the course of the year, we brought down the overall manpower cost. And it's something that we alluded to even during the course of this interview. We spoke about the fact that it came down, and in this quarter it's been particularly low. So all of this helped, and of course the introduction of products across various markets, across the most important markets, would certainly help nudging the EBITDA margins going forward. And of course, there's always going to be continuous emphasis on cost reduction.
And regionally, if you have to highlight any particular region which was
the most important regions for us, so America remains the most dominant region, and there's of course, we have never lost taking the eye off the ball when it comes to India. So there is operating leverage in India, which we wanted to optimize on, operating leverage in other parts, including Europe, APAC region, and of course, the Latin American region. So all of this. So I wouldn't like to actually place emphasis on one particular region as being the cause for decline. It's it's singularly because of the fact that we have not had enough products going for us in America.
Okay. No, of course, we understand India and US are the key region. I just wanted to understand if there was any other region which was creating any kind of impact, particularly, or else it is the product launches that we have seen.
And we also had specialty losses in America because we, of course, SoloSec didn't get the kind of levels that we expected it to, and that contributed to losses in America. And so we have rationalized the sales force in order to keep that on a leash.
Okay, and just to Vanita. Vanita, could you highlight our strategy on SoloSec going ahead and any other new product additions, especially on the specialty side in US that you would expect over coming 2 to 3 years?
Yeah, so our strategy through the pandemic was to really conserve cost and restructure, which we have. Brought spend down significantly through a combination of reduced footprint of the sales force plus virtual interaction with the physicians. And at this point in time, we are focused on the next major lever, which is the trichomoniasis launch, which we hope to do in the next quarter, actually. We are waiting for feedback from the agency, and will time really a relaunch of the product, although still with the lower level of spend at this point in time. So that's where we are on SoloSec. I mean, with the changes that we have made, we expected some disruption. We have seen disruption, but in the last couple of months, we have started to see some growth, although minor. I think the major trigger for us is going to be Trich, and likely see the impact in the second half of the fiscal year. And simultaneously, we look for the opportunities. We are looking at a couple of other opportunities right now that potentially will be accretive for the women's health business, and building up a pipeline. We have had really good success with 3 programs in the pipeline on the women's health front with the agency, and in particular with 2 programs we've had success with the agency, and are progressing them into the clinic very rapidly.
Thank you.
I know we're out of time. Maybe we take last 2 minutes to take a couple more questions.
Yeah. Sorry, as we are out of time, we'll just take last 2 questions. Next question is from Forum Parik.
Hello, am I audible?
Yes.
Yeah, so I had 2 bookkeeping questions. I see that raw material expenses as a percentage to sales have come down, and this is the second quarter where we have reported lower percentage to sales. So I just wanted to know, like, what is the reason and is it sustainable? And second question is on the capex front. Do we intend to have any incremental capex in the next 2 years?
So firstly, on the raw materials front, so as I was just alluding to a few minutes ago, we have been working on, in fact, bringing down the overall procurement costs and the like. So some of it is, because of that, the outcomes of those initiatives. And of course, there's always the sales mix, the production mix, which goes into the financials for any particular quarter. So it's actually really a resultant of that. The second was on capital expenditure. What about that?
So do we intend to have any incremental capex in the next 2 years?
No, so our budgets, so we really are into an optimization mode on everything, given idle time and all of that. So this year we would think that it's going to be close to 1,000 crores.
Okay, that's helpful. Thank you.
Thank you. Next question. The last question for the day is from Harsh Beria.
Hi, I have a question on working capital of the business. So this has structurally increased from, let's say, 100-day level to like 150, 160 days. What is the sustainable working capital levels that you guys see going forward?
So there has been actually an absolute decline vis-a-vis the previous quarter. But we take your point that it has actually gone up over the last couple of years. Even now it's hovering around the 145 days operating days. And we are trying to work on that. It's actually a function of, in fact, when do we make those sales? So anything done in, and as long as it is something which is within due dates, it doesn't get, it doesn't get, translated into cash. And that's the reason why you find that the overall accounts receivable, for example, is on the higher side.
Yeah, this year I think the receivables actually did a little better. It was, maybe because of it was inventory which contributed to higher working capital. I was wondering, like, can this come back to like 100, 120 days, like in the next few years?
So we have been trying to work on all of that, but as I said, COVID also, there have been some supply chain disruptions and so on. So it really pays to kind of stock up. So it has been a function of the context in which we are operating as well.
Yeah, that's it. Thanks.
Thank you. I now hand over the conference to the management for closing comments.
thank you. This brings us to the close of today's session. Hope you got the clarity that you were seeking. Look forward to connecting with you all next quarter. And I'd like to thank you on behalf of my team for your continued interest in our company. And in the meantime, look after yourself, take care, be safe, and be healthy. Good luck. Thank you.
Thank you.
Thank you. On behalf of Lupin Limited, that concludes this conference. Thank you for joining us, and you may now exit the webinar.